Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sharad Avasthi and you're watching Your Stocks. Joining in today are two experts, Sharad Avasthi, head of PCG Research at SMIFS, and Kush Bohra, founder at kushbohra.com. Gentlemen, thank you very much to both of you for joining in. The first query today is coming in from Mumbai. M. Satya Srinivas has written to us. He says he has 600 shares of Dilip Buildcon at 400 and he has 2,400 shares of Yes Bank, which he has bought at 13. He says now that he's making losses in Dilip Buildcon and wants to know whether to remain invested or exit at current levels, as well as his second holding that he has in Yes Bank. What is the advice for that as well? Okay, so let's take this to our two experts. Sharad, first to you on both stocks. What is your recommendation?
So for Dilip Buildcon, I think it is a bit risky given the leverage issues that the company has. Though we expect that with a 23,000 kind of order book, there is a high possibility that the numbers could show some sharp recovery or improvement over the next 1 or 2 years, because the spaces it caters to, largely civil infrastructure, it is a space which we expect to grow very handsomely. Since the company has the leverage hangover, if he is a high risk investor, they can continue to hold on to it for a target of 300. But assuming that 20 rupee EPS gets a discount of 15 times. But if he is a conservative guy and he does not want to take that chance that something would come out of the woods and get into positive, then it's better to switch to something like Ashoka Buildcon, though a much smaller company, but the earnings growth and the valuations are much more attractive vis-a-vis Dilip Buildcon. The second stock is Yes Bank. I think growth will remain muted for the next 2 years for the bank in terms of book value accretion. We are expecting 1.5 rupee kind of accretion to the book value. The stock is already trading at somewhere around 1.5 times current book value. So I think there is not much scope in Yes Bank from here on. It would be better if he switches to a Bank of Baroda, because the corporate loan book growth should help more the PSU bank side of the business. And even if Bank of Baroda trades at around 1 times forward price to book, the targets could be somewhere around 180. So both stocks, I think he should switch Dilip Buildcon to Ashoka Buildcon and Yes Bank to Bank of Baroda.
Okay, that's the advice coming in from Sharad. Kush, what would you recommend?
Well, fairly similar to what Sharad just mentioned here. Dilip Buildcon has been in a downtrend, both near term and medium term. Now, this is not auguring well for the stock. Every rise is getting sold into. So here the advice would be, if he wants to hold on, then hold on with a strict stop loss of 185, 190. These zones have been a long-term support. If the stock breaks, then you're advised to move out of this. I don't see too much of an upside. The stock could rally up to 250, 245 zones, but even there we've seen selling pressure emerge. So that could perhaps be an exit point. But at 185, 190 zones, a very strict stop loss. And as far as Yes Bank goes, again, 5 years is a long time, anybody's guess. And the good thing is that he's bought it at a fairly decent price, 13 rupees. So if he is a long-term investor, hold with a stop loss of 10.5. But for such a long duration, you're better off switching to someone like something like a ICICI or an Axis. So my suggestion would be switch from Yes Bank and exit DBL with strict stop losses around 190 zones.
Okay, the next query comes in from Sarita Nanda. She has written in from New Delhi. She has shares in SBI, so 100 shares which she has bought at 250. She's making some money there. She's a medium-term investor and wants to know if this is enough money. Should she take it off the table, or is it good for more? Kush?
Yeah, well, I think the PSU rally has only just begun, and SBI being the leader of the pack will see better days. The stock had moved up to 580 levels and just corrected and consolidated from there. The advice would be to hold on, because the stock is in a consolidation zone right now. Once it gets done with the consolidation zone, it could see much higher levels. I wouldn't be surprised if the stock sees 660, 650 zones also in the coming months. Since she's a medium-term investor, hold on to SBI for a target of about 650. Here the stop loss would be 475.
Okay, Sharad, what would you say?
Yeah, I think it's a decent bet. After this recent correction, it's become even more attractive. And we think that there is a strong possibility that most of the PSU banks could get re-rated higher. Right now, even the cards business was going through some turmoil because of the travel restrictions and slowdown in travel and all that. Now, with all that coming up very smartly over the next 2-3 quarters, I believe that will also aid. The AMC business valuations are also a bit subdued at this point in time across the board. That is something we are expecting to racket up over the next, say, 1 or 2 years. So that should also help the valuations of SBI. Further, coupled to that, the primary business will also see some very good growth. We are expecting very healthy advance growth for the banking sector throughout, and SBI should benefit maximum out of it based on the corporate loan book they have. So I think FY24, the book value should be somewhere around 430, 450, and the stock should easily command 1.5, 1.6. So she should continue to hold for targets of around 650 to 700 on the stock.
Okay, up next, Mausumi Das has written from Asansol. She wants to invest in stocks, and the ones she has shortlisted are IDFC or Raymond, and the time period that she has in mind is 2 to 3 years. She says that she's a long-term investor and wants to know which of the two stocks would be the better bet. Sharad?
Raymond is a pure play on the basic brand that it is, and over the near term, I think it could have some very good, decent upside based on the type of demand we are seeing for the marriage season and the festival season that we have here. So Raymond should benefit out of that, and it's a strong brand. The real estate division has been doing very well over the last few years, and the ramp up there has also been very robust. On an SOTP basis, we think Raymond, the fair value should be around 1300. IDFC, it would be based more on the merger. Most of the divestments are done. The GNPS and NPS have been under control. They have been very aggressive regarding their long-term commentary, etc. on the bank. So I think post-merger, there is a decent possibility that IDFC has around 25-30% upside. So both stocks have decent upside. But considering you want to buy one, I think both can be bought. But if you want to buy one, I would go with IDFC Limited. I think you can buy IDFC with a target of around 95.
Okay, Kush, you like any of these stocks?
Both, so much so that I'd suggest have a 50-50 allocation to both of them if these are on your radar. A very simple reason being both of them are in a very strong medium term uptrend. IDFC also has been doing rather well, and here we're looking at targets of about 95 to 100 zones. As far as Raymond goes, the stock has been a little more volatile as compared to IDFC, but here also the medium term trajectory is pointing upwards. Here also the target would be around 1500, so hold with a stop loss, or rather enter with a stop loss of 1050. Both look fairly well on the charts, and 50-50 allocation would not be a bad idea.
Okay, Pradeep Chordia from Bengaluru has written. He says he has 660 shares of Kalyan Jewellers at 69. So he's making money right now and wants to know, should he remain invested or take money off the table right now? Kush, do you see more upside here, and what's your target?
Well, incidentally, this has been one of our calls. So and plus kudos to the gentleman for buying it at such a interesting level and holding on despite the sharp run up. The stock's actually just broken out of a very strong resistance zone of 100 and is comfortably trading above that. The volume action is also picking up. So I would suggest the stock has some more good days ahead of it. So I would suggest hold on. 125 is a very conservative target that we're looking at. Here, a trailing stop loss for him would be 95 rupees. So hold on to Kalyan Jewellers.
Okay, Sharad, what about you? Within the peer group, how do you rate this stock, and what is the upside that you see?
Yeah, we also rate it very highly. I think after Titan within the jewelry space, this will be the second largest player. And they have a pan-India presence. They are expanding their presence out of South and into the rest of India. And recently, they have been working on the franchisee model also, which we believe that they will very aggressively accelerate over the next 2-3 quarters as well, and even the 2-3 years. So that should benefit them big time. We are expecting even hallmarking to be a very big beneficiary for the organized sector. And we are expecting earnings to grow at a CAGR of around 25%. So for FY24, the earning could be somewhere around 5 rupees. And considering that Titan, etc., hold it around 40-50 times forward, we think this stock could easily get somewhere around 30 times. So implying that, I think that he can hold on to it with a target of around 150.
Okay, on that note, we're going to take a very quick break. We have more queries to answer, but we'll do that when we return. Stay tuned. Hi, welcome back. You're watching Your Stocks. Our two experts, Sharad Avasthi of SMIFS and Kush Bohra of kushbohra.com, are with us answering all our queries. And the next question that we have comes in from Vivek Kumar, who has written in from Rajkot. He says he has 200 shares of Dish TV at 18, 50 shares of Indiabulls Housing at 138, and 70 shares of Indiabulls Real at 84. He's a long-term investor and wants to know, what could be the future prospects for his investments. So, Sharad, first to you, the two Indiabulls companies and Dish, what is your recommendation?
Indiabulls, both the companies I do not track, but Dish TV, I think in terms of the type of shift we have seen into OTTs and everything, I believe the Dish TV space is very crowded and very saturated. We are not expecting much growth over the next 2-3 years. Also, growth should be very muted at around 1 to 2% at the top line level. And if you are not being able to grow at the top line level, it should be very difficult for these companies to sustain. I think it's better to switch to something like a Z, where the Z-Sony merger could also catapult them into a different league on the OTT platform, and that should do much better compared to Dish TV. The issues with Yes Bank are another chapter that they have, which is a problematic area. So I think it's better to get out of Dish TV and switch to something like a Z.
Okay, Kush?
So from a trading perspective, Dish has broken out of from its resistance zone, which was at around 14 and a half, and it's seen some correction from 22 levels. Although the overall trend is positive, I'd suggest keep this as a trading bet as at best. Here the target would be 21 and the stop loss would be 16. As far as the Indiabull stocks go, Indiabull real estate is an exit. There isn't much that is happening there. The stock's been in a downtrend and every rise is getting sold into. Indiabulls housing finance, however, is a slightly different story. This stock has been under some selling pressure, but it's gaining momentum. The volume action is also picking up. So here I would suggest hold on with a tight stop loss of 120. The stock has the potential to move at about 145 levels. Those could act as a exit point for the investor.
Okay, Sita Ram Mittal from Meerut in UP says that she has 100 shares of Nykaa at 1304. However, she is making losses. She wants to know if she should remain invested or what should she do, given also that there is a bonus issue ahead. Sharad?
Yeah, I think valuations continue to be a normal part of this whole space, the new age companies. But the other point that we also need to understand that these numbers can change very fast. In the case of Nykaa, if you look at the FY25 numbers, they are still trading at around 110 times. The expectation is of an EPS of around 11.33. But this was around 18 to 20 rupees 8 to 9 months back. So you can very easily understand the type of growth that can happen into these companies. But valuations don't seem to discount anything with respect to the risk that this kind of growth has with it, because the challenges are many and multifold. It's not as easy as it seems in the valuation. So I think it's better that if you are a high risk taker and if you can extend the horizon to say 3 to 4 years, only then it makes sense to stay into Nykaa, because growth could surprise you on the upside. But if I were to decide on the current status of it, as a conservative investor, one should not be holding Nykaa at these valuations.
Okay, Abhay Desai from Pune has written in. He has 20 shares of Gillette at 6,100. He's a long-term investor and wants to know what he should do at the moment. What is the recommendation to book his losses or to remain invested? Kush?
Sure, the idea would be to exit, because the stock has been in a downtrend. Any attempt at rise has been sold into. So in one word, the answer would be exit. It'd be better off switching to something like a Titan. It's a slightly different play, but similar segment. So better off switching to something like a Titan. Gillette at the moment is an exit right now.
Sharad, what about you?
Well, in terms of upside, I don't think from his price how much upside he will get out of Gillette, but from current prices, I think there is some decent upside left, because over the next 2 years, we expect the company to grow at around, say, 15-16% at the bottom line level. 75% of the 75% of the revenue comes from shaving products and grooming products, where they're also expanding into oral care as well. 20-25% is coming out of that. So gradually after COVID, I think shaving might make a comeback in India because beards have been in style for around 3-4 years now. So that's bad for Gillette. Globally, that was the thing that caused them a devaluation. But in India, I think with the product mix, there is a possibility that we could grow at around 15-16%. And with the type of brand value that it has, I think 40-50 kind of multiples are easy. So considering 50 times on FY24 earnings of around 119, he could hold for a target of somewhere around 5,950, 6,000.
Okay. CV Kumar from Mumbai says he wants to invest in HCL Tech. Considering the present volatility in the market, he wants to know, is it a good time or should he hold off for some time? Kush?
Sure, it's a good idea to get into IT stocks, specifically HCL Tech. The only thing would be that the stock's already seen quite a bit of run up on the back of decent results and technically on the back of good volumes. So the best strategy would be to buy this in a staggered manner. The good entry point would be around 950, 960 zones where a lot of support points converge. So get into HCL Tech around 950, 960 zones and buy it in a staggered manner.
Sharad, you'd agree?
Yeah, I think that's a very decent strategy. What Kush is recommending, that you gradually accumulate the stock, because I believe after the results, there has already been a 10% kind of movement roughly in the stock around the result and just up before the results. We consider that gradually the IT space will mature into a space where you will continue to see 15-16% growth for the frontline stocks, and valuation should settle at around 20-25 times. Though in terms of current pricing, I think HCL Tech, we are expecting an earnings of around 65 rupees in 24. So considering 18 times, I think 1110 is the target that I would recommend. So yes, staggering your purchase is a very good idea considering the recent run up the stock has seen.
Okay, gentlemen, thank you very much for joining in today and for advising our viewers. We're going to wind up on the show for now, but do remember to keep sending us all your queries and we'll take them up. For now, we'll take your leave, but the team of Closing Bell joins you next.